Hey everyone, welcome back to another episode of AWM Insights. 2026 is certainly getting started with a bang. But before we jump into what those topics are and why that gives us a little bit of a smirk, I'm your host, Justin Dyer, Chief Investment Officer here at AWM Capital, always joined by Mena Hanna, Portfolio Manager at AWM Capital, and my right-hand man on AWM Insights. And as I alluded to, right, we are 2 weeks largely into 2026. And gosh, it seems like every day or every other day, there is a major, not just, interesting news item or event. There is a major potentially market moving event out there. So we're going to talk about quite a few of those. They all kind of weave together. But it seems kind of what is top of mind, Mena, and you correct me if I'm wrong, but it's the kind of precious metal thing. And that is really the through line that is being driven by a number of these bigger stories that I'm sure everyone is aware of, right? The Fed, the geopolitical side of things, you name it, right? Again, there's a number of very interesting stories coming out, either has come out or coming out, right? You even throw in the Supreme Court eminently about to weigh on the tariff policy. Like that's going to be quite an interesting day when it comes. Maybe it will come after this has been recorded. But let's jump into the precious metal, or really gold, right? Gold is the shiny one that gets the most attention. Silver has been in the conversation as well, but kind of riding on the coattails of gold. But Mena, why don't let's start with a quick reminder. I think we've recorded this at least in the last year, but it's always great to go back to first principles. Like, at least what do we think about gold from an investing standpoint? And then we can get into like what's going on with it right now. Why is it behaving the way it's been behaving? All that good stuff.
Yeah, from an investment standpoint, and when we think about creating a portfolio that has long-term potential and long-term gain potential, we want to invest in something that creates cash flows, something that has some form of cash flows. And the best way of doing that over time has been to invest in businesses that are profitable, that are productive, that give you a return of capital in the form of dividends and also capital appreciation as they grow, as they just scale and develop new technologies, release new products. You have the benefit of capital appreciation and of also cash flow from dividends. So we really look at growth in investing in something that is going to yield something over time. Gold, silver, precious metals in general don't fit that quota, that status, because they have no cash flows. You don't make money by holding a bar of gold. I would actually say you lose money because you have to pay insurance costs, you have to pay for storage. If you're doing it, you buy a safe. If someone's professionally doing it, they have their own security that they're paying for, they pay for their own insurance, and you as the holder ultimately have to pay for all of those costs. There's no free lunch. So instead of investing in something that has positive cash flows, you invest in something that has negative cash flows. And your only hope there of having a successful outcome is that more people tomorrow want to buy what you have. The supply stays low, the demand increases, and you just get the benefit of capital appreciation from more demand. And to me, that's a hope-based strategy. That's not an investment strategy.
Totally.
Not sure what you would add to that.
The only point I'll put on it, and then we'll get through all the boring stuff, is the reason why we do this or don't do that rather, is because we don't have a confidence in the outcome. We don't have as high a confidence in the outcome. And in order to support true multi-generational wealth, the 100-year family, we want to have as much confidence in the investments we're making on your behalf as possible versus the more speculative nature. It doesn't mean gold will not appreciate in price or depreciate in price. We just don't have confidence in how it behaves and when it will behave in certain ways. Now, I will say it hasn't actually outperformed equities, even though there are some strong advocates, or the S&P 500. Let's just use that. It hasn't outperformed, even though there's some strong advocates that believe gold is the end all be all. But it also just doesn't have these predictable movements that we can really have strong confidence in to rest your family's future on at the end of the day. So, very important point. A lot of kind of the nuts and bolts, nitty gritty there. It's out of the way. What's going on with gold, right? It has been on an absolute tear. It was the best performing major asset last year, had a phenomenal 2025. It's continued to move up pretty strongly so far in the first couple weeks of 2026. What is going on, Mena?
Yeah, there's a lot of things going on, and we have to get a little bit political here. But a lot of the geopolitical tension is going to be a tailwind for gold and any kind of precious metal. I would say, and we've actually seen this with Iran and how their banking system completely shut down recently, but when you're not able to access your capital from a banking system because of a geopolitical conflict, the only thing that you can really trade or have access to is gold, precious metals. So in times of stress like this, you will see people buying precious metals. The other piece, and this is tied to the comment that you made earlier around the Fed, there's a lot of distrust with not only our Federal Reserve, but a lot of central banks and Federal Reserves out there. So when that happens, you have people not believing in currencies, fiat currencies, whether it's the dollar, the euro, the Iranian rial, and you have people having to shift that money from currency to something else. Typically, when there is a flight to, call it safety, people will buy precious metals a lot of the times. If they don't believe in the currency, you're going to buy something physical that you can see, that no one's going to remanufacture, that's just there for you. So all of these things together have led to, over the past 14 months, have led to fantastic periods of return for gold and silver. But these are really like anomaly time periods. If you go back and if you look at the price charts of both of these precious metals, and we'll throw a few graphics up right now, you get these massive spikes up in value, and then you typically get sell-offs when things cool down, when people chill out a bit, when there's less stress going around, and there's just a, call it, return to the mean. And if you really look at the annualized return of these precious metals over time, it's kind of underwhelming. So that's what I see from a high level, from an investment viewpoint. Gold is just not the best place to put your money over extended periods of time.
Right. And benefiting from those environments where it has peaked or spiked rather, that's predicting the future. Now, some people say, oh, well, gold's a hedge. Well, you know what? Hedges cost money. And if you have a well-structured portfolio, a well-built portfolio, we've gone through that, right? Build the foundation. So then you can have this strong structure and then build the nice amenities outside of that, right? If you think through portfolio construction in the right way that supports your unique priorities, you don't need those type of external hedges like a gold in order for your priorities to be met. And again, you're also costing yourself money, whether it's because you have to pay to hold the gold, or you're paying in missed upside, if you will, based on the returns that Mena just highlighted. It's just it really isn't, the juice isn't worth the squeeze. Let's use that good old adage around gold in its place in the portfolio. Now, again, there are periods of time where political instability or inflation concerns or distrust in currencies does drive uncertainty around the world and the price up. And this is one of those periods of time. You can't always be in every single asset at after the fact, right? Like that is just kind of the nature of investing. And if you were employing that sort of strategy, you would basically be chasing your tail and buying high and then selling low, which is a recipe for disaster. Let's just go through. Oh, go for it.
No, I was going to say there's one thing that's also, I did a bunch of research beforehand that was fascinating. You mentioned that gold is kind of having its moment right now, and it hasn't really gone anywhere for, call it the 10 years prior to this real rally. If you go into a lot of the AI tools, and this is where I think finance and financial literacy as well, they're both so important, knowledge and literacy. You ask a lot of these AI platforms, hey, compare the S&P 500 with gold over the last 30 years. I did this just to kind of produce these numbers. It'll give you a wrong return. And the reason it gives you a long return is exactly what you said around the cash flows. It, first of all, doesn't factor in any negative cash flows for gold, which, okay, let's just give it that. Let's say you're able to buy gold at spot. There's no storage costs. You throw it in a drawer, you never lose it. You're all good on that end. AI is looking at, and a lot of these precious metal marketers right now are just looking at the price of the S&P 500 without reinvesting dividends. And that moves the needle significantly in when you actually pull the correct amount of the total return of the S&P 500 and reinvesting your dividends. Gold gets blown out of the water by the S&P 500 and by other just equity indexes. And that comment that you made again, like you are giving up a lot. And if you had only been in gold for the past 30 years and compared that to the S&P, you gave up a lot, and you gave up even more if you held it for 50 years or for 100 years. So your best long-term strategy is to invest in these profitable cash flowing businesses that we do have certainty of having a positive return and a really good return over extended periods of time.
Yeah. And I mean, that's a great place to start to wrap it right there. Like that is the purpose of this podcast. We want to take topics, questions that come from you, all the listeners, or that are just generated from current events, right? Like we've said plenty, there's a lot going on right now, and distill those down into the long-term mindset. There will and always have been periods of time where these specific investments capture people's attention. It's even more pronounced nowadays with social media, where the virality of certain topics just gets reset and reset and reset and amped up and amped up and amped up. And we just want everyone to learn and remind yourselves listening to this podcast that there is a tried and true method. The data supports being patient, taking a step back, having a thoughtful approach. You name it. Go back and listen to plenty of our other podcasts, and you'll get what I'm talking about here. Hopefully, this one in and of itself today is a great reminder on not chasing your tail with respect to gold, but also what's going on, right? It is interesting to follow some of these stories. Certainly, it is from our vantage point, and we love talking about them. But we also know through years of experience, years of looking at the data, what the best way to support your 100-year family is, which is a very patient, long-term, purpose-driven, very tailor-made approach to money management. So hopefully that's helpful. We'll wrap there. Oh, you got one more point. Go for it.
Yeah, on the 100-year family side, you just triggered another point in my mind, because I looked this up. If you would have invested $100,000 in gold 100 years ago, you'd have a little less than $20 million. If you invested that same 100,000 in the S&P 500, you'd have $2 billion. So that is the difference. It's a difference of 5% annualized, but compounded for 100 years, you have 100 times as much money in the S&P 500 as you would in gold. 2 billion compared to 20 million. It is shocking. And yeah, we just have to be, everyone is investors. Like I will look at gold and I have some FOMO, but you have to kind of differentiate short-term movements from long-term fundamental facts that we just trust more than these short-term movements.
Yeah, 100%. Yep. Thanks for getting that in there. Appreciate it. We will wrap there. And until next time, own your wealth, make an impact, and always be a pro. Thanks for listening.